growing a small account, this is going to be a fun one. Got a lot of historical data in here for you, got a lot of strategies in here for you, and I think we're going to hopefully remedy some of the pitfalls of having a small account here with our smaller products and all the efficiency and the investment opportunities that they afford you. Before I get to all of that, I have to give you this, which is a disclosure laying out what futures are, what they are relative to stock and ETFs, the leverage that they afford you, but the risk that they also may contain here. I'll keep this in front of your eyes for just a couple more seconds, and then we are going to have an absolute ball in a second here. Now, what are we going to cover? We got an agenda. We're going to try to stick to it, but we might get derailed, especially if there are some good questions in the chat. This can go anywhere. We love reaching out to our community. We're glad that you're here. So let us know what you're thinking. Let us know what you want us to cover, and we will get to it because we love all of you out there. But the agenda is thus. Let's define growth. Let's go over some tried and true tactics, and then let's lend some of those tactics to growth in a small account. Let's start it out. Defining growth, well, just the general concept of growth. And of course, you're going to know what the word growth means, and you're probably going to know a couple of these first points that I hit, but I want to paint this picture with a couple different colors, maybe get that brain shifting in a couple different ways. Growth is simply the process of increasing anything due to an investment of time, effort, or money. Now, you can witness growth in plants that you have around your apartment or house or landscape outside. You can grow your mind reading books and news items and research and everything else. But today we're focusing on growing that money, which unfortunately for a small account requires probably all three of these items, which is time, effort, and money in there. If we were talking about this for a large account, the conversation would be a lot shorter because all that large account needs is money to pick up smaller returns and passively get to that growth that they want to see. But those smaller accounts out there need a little bit extra time and effort in there with the money to get where we need to be. And we are going to get there by the end of today's presentation. Believe you me. First of all, let's define financial growth. Get a little bit deeper here in today's conversation. Usually viewed as wealth appreciation as a function of returns on investment in stocks. Here is the S&P 500 from 1990 until now. You can see it's a lot higher than it was back then, actually looking a little like the Bitcoin chart of the last 10 years here. Now, why is investing in stocks so popular? Why is it the first place that small, medium, and large accounts tend to go when they're looking for growth? Well, because it's done very well. And if you have a large account, growth looks very, very easy. From 1990 until now, you're looking at an average annual return in the S&P 500 of 9.7%. And so if I have an account size of $100,000, I'm looking at adding 10 grand every single year by just passively investing in the stock market. That's great, and as we'll see in some future statistics, that gets me to a place where I'm comfortable with retiring, or I'm comfortable with buying, a house, or doing whatever I want to do in a relatively quick fashion. Now, while small accounts get that same return, not going to shock you with anything like that, where small accounts you get a smaller return. You do get a much smaller nominal number, and this isn't a surprise to anyone. Like I say, you probably understand these facts, but picking up $500 on a $5,000 account, which is our small account example here, that's just not going to do it. It's going to take a lot of time to sit at that 9.7% rate, which, albeit, is very, very good. I remember when I actually was still in college, interning at a wealth management house, and everybody there was just trying to beat 7%. That's the long-term average in S&Ps. Well, given the last 5 years or so, the average is now up to 10%. That's a great return. That's fantastic. But having a small account of a few $1,000s is really not going to get me to the place that I want to be in the next few years to be potentially retiring, or to be, buying something for me and my significant other, my family, whatever your situation might be. After 10 years of passive investment in the S&P 500 at these historical statistics, growth from the large account perspective can create a retirement level amount of wealth relatively quickly. Now, once again, the rates aren't different. You're experiencing the same rates from a large or small account perspective, but from 100 grand, I can go to 260. That's something I could comfortably, think about retirement on. Whereas going from 5 to 13, same effect of doubling, more than doubling over the span of 10 years. That's probably not getting me to a comfortable place where I can start to think about these things. It's not the growth that I necessarily need to see. And on top of that, you mentioned this kind of what's quickly becoming antiquated idea of even greater returns being reserved for those large accounts in the way of hedge funds and different wealth managers that thankfully are kind of, like I say, starting to become not necessarily an idea that's gone, but it's losing some flavor because all of you small account traders out there have small futures at your disposal, have so much more research at your disposal to try to get to these greater returns, which we'll get to in a second. But you look at, and I simply present the chart, the percentage return chart of Apple here to show you that in the 90s or the early aughts, a small account not having the ability to hire a wealth manager or to invest in hedge funds that need you to have at least 100 grand, potentially millions to invest to even get in the door, that's where you get those greater returns and that greater growth. And so once again, a barrier to entry for those small accounts, but we've worked so hard to reduce all those barriers. And this is something that I want people to really take note of. I always love, given my math background, to simplify ideas to maybe one nice, clean equation. Now, I've shown you that a large account can passively invest at a return that's maybe not competitive with some of the burgeoning stock industries out there. Just a solid S&P 500 return. I can passively invest in there and not worry about getting a higher return necessarily because I have such a large amount of money. What do I need to do from a small perspective to get to that growth amount and to get at least somewhere near the nominal growth that a large account is seeing from their passive perspective? What I need to do is produce greater growth metrics via a larger expected outcome. And now expected outcomes are simply where your probability of success meets your average return. So any strategy, whether it's buying Apple versus buying Microsoft, selling puts versus buying calls, it can be as simple or as advanced a strategy as you make it. They all have expected outcomes, which is, okay, historically this is hitting at a 70% rate and it's got an average return of 2% versus this thing is hitting at a 30% rate, but it's got an average return of 15%. Comparing those things is really useful in math theory, and we're seeing today in the growth potential of your investment. And all we want to do to get closer and closer to what the large account can do on a passive basis is get our small accounts on an active basis to have a greater expected outcome. Once every inch that we get ahead of that large account, an expected outcome is going to get us closer to those nominal returns that those large accounts are seeing. So let's get back to this strategy that is so tried and true with just the simple investment in stocks. Since 1990, buying the S&P 500 has produced an annual success rate of 80.8%, which is kind of wild to see given the fact that theory would dictate any market on any given day or any given time frame has a 50-50 odds that it goes higher or goes lower. Stocks, you've probably heard this elsewhere, but just to hammer it home with that big number in there, they have an upside edge. And that is why large and small and medium accounts invest in equities, and they don't choose something like, some people do, but they don't necessarily blindly buy gold or blindly buy crude oil or blindly buy any of these other asset classes that are semi-range bound over the decades. Is because this stock market is not range bound. It was at a price in 1990, and then it was at a higher price in 2000, and then it was at a higher price in 2015, and now it's at a much higher price here in 2021. And so this is what makes, that large account content with a simple passive investment, that 80% success rate teamed with an average return of 9.7%, almost 10% annually in the S&P 500 since 1990. That's not just positive. I mean, I'm more of an active trader. I trade on a minute by minute basis sometimes here, and we're looking for edges of, if something has an average return of 0.5% or even 1%, I'm looking to get that edge and get in the market for the next couple of minutes to days. For longer term, just like simpler things that can get a small account to greater growth potential, 9.7% is huge. That's a huge amount of edge on an annual basis in the stock market. When you put those two things together, you've got an annual expected return of 7.8% in the S&P 500. And that's, once again, just kind of unheard of when it comes to expected outcomes and just markets in general. You put together, a long strategy, like I say, in gold or crude oil or bonds or some of these other markets, you're going to have some really nice highs, but those lows are going to tend to level it out. You look at this S&P 500 chart and you look at these statistics, and you can see why this is such a tried and true technique of just going straight to that stock market and investing. Now, the simplest way for us to enhance our growth in a small account is simply to enhance that return. I mean, how can a small account beat that expected outcome of the larger account? Well, simply beating the average return is a really good start. And this is why I love to lay things out in these relatively simple ideas, these relatively simple equations where you've got two parameters. Is like, okay, well, if I need a higher output and I've got these two parameters, all I need to do is try to jump up one or both of those parameters to get to that higher output. Now, this is where futures come in. Futures offer lower costs, which can translate to higher returns. All those returns, those 9.7 average and everything else, are based in buying and owning equity. Here in the small stocks, which is one of our favorite products here at the Small Exchange, it's one that we launched with more than a year ago. You've got a market that has a stock value as of today of $7,700. Now, if I have a $5,000 account, how do I get $7,700 worth of stock that has a high correlation to the S&P 500? Well, futures, given their efficiency, they're going to require that you cost less or put up less than 10% of that stock's value in its current cost. That's the margin, $750, currently sitting between 9 and 10% of the product's value there. Right there, you have already increased that potential return with just a lower cost. Now, lower costs on the same stocks can take you from what's been a pretty darn couple of years here for the SM75 stock futures. You can see they're up about 50% since the start of 2020. Now, when you add in the efficiency of futures, that lower cost, you've got yourself a return that's closer to 500% there. Paying less than 10% of the stock's worth quickly amplify potential returns tenfold. Now, we'll get to the risk here in a second. Don't you worry, because this isn't a matter of just lever everything up and it'll be good. But this is already a small thing, just getting a little bit more active, going from stock ownership to a derivative space like futures is going to increase your returns potentially tenfold here. That amplification can create for much greater potential. Now you've got an account that is 1/20th the size of that larger account example, 5,000 versus 100,000 there. With the efficiency of futures, those same returns, that same stock market is now getting you an expected return that's half of what it was for that large account. Those numbers, once again, 1/20th the account size, getting you to half of the return of an account that's $100,000. And that's one simple idea there. But what we do with that efficiency is we increase access with futures and not necessarily exposure. A $5,000 account could theoretically get more than $50,000 in stock exposure via futures. And if that's your game, you've got it all in front of you here. Like I say, $5,000 account can potentially use small exchange futures to get $50,000 worth of stock exposure. But it's probably a good start to just get more than your money's worth in that stock exposure. And then you can kind of toy around with these ideas as you get more comfortable. That small stock 75 product, once again, that's a product that's almost $8,000 worth of stock costing you less than $1,000. So maybe that's a good start. I've got $5K. I can buy one of these markets and get a little bit more than my money's worth in stock exposure and take up just a tiny amount of my account that allows me to do so many other things. And we'll get to those other things here in a second, because where futures go wrong and where they've gone wrong in the past is I've got $5,000. I want to get that return of the $100,000 account. So I'm just going to lever up, and that's where you get problems with some of these traditionally large futures. Thankfully, ours are pretty small, that if you buy one of the stock futures and you have a $5,000 account, the market would theoretically have to move to zero for you to lose all that money in your account. Now, where traditional futures have gotten maybe too outsized and too leveraged is in the fact that if you do fully lever this $5,000 account, you could theoretically lose all 100% of your account. And that's, that's obviously not a good thing, but that's not something that you get in the stock and ETF world, because you put 100% of the cost into that stock and ETF investment. And so worst case scenario, it goes down to a couple of pennies, and you can lose near 100%. In futures, you can lose that 100%. And you can see here in the chart, if you had chosen to commit this fully leveraged strategy in March of 2020, you're going to lose that full account in a matter of a couple of weeks. So like I say, you can get $50,000 worth of stock exposure for $5,000 using futures here. But we like to say, get more with, one or two of these contracts. Don't fully lever, and commit all of that money to a diversified approach, because this is really where it's at. And we're going to get back to the formula here in a second and commit it to some other markets. It's a matter of taking that $5,000 that is only inching along year after year, putting that $5,000 into more than $5,000 worth of stocks using the small stocks futures, and then having 80% of your account there to do other things, to maybe get some exposure in an interest rate market that's near its lows, maybe to get some short exposure in a crude oil market that's back to its highs. All these different things you now have the room to do, given the efficiency of these products, and you've got that growth still working at a better rate than it did with the full investment in stocks. Now let's get back to this formula, because I want to give you a couple of ideas here before getting to the Q&A segment on ways to activate that other 80% of your account, because a more active way to enhance growth in small account is to simply enhance probabilities. This is the other side of that equation. Increasing the probability of success while keeping returns steady can also work in the same way that in the last scenario we kept that probability of success static and just increased our returns by using more efficient, less costly products. As long as your daily return on any trade, and this is, you're going to love this, we're about to get this here in a second with some of our different markets, crude oil and metals included, all you have to worry about on a daily return basis to get to or beat that average return of passive stock investment is a daily return of 0.1%, a weekly return of 0.2%, or a monthly return of just 1%. That annualized will get you to that return that beats the passive investment. And if you can get those simple small returns with our simple small products with success that is 80%, 85%, 90% in some of the things that we're about to look at. That's another way to get that growth greater in your small account that's now active as opposed to the passive larger accounts. So what are we looking for here? Well, one of the things that I love to look at in all diversified markets that sit next to my investments, my long-term strategies in long stock exposure, is contrarian takes on standard deviations. And this is really nice and clean and simple because the probabilities don't change. The market changes on a minute-by-minute basis, changes every single day. The landscape we're looking right here at SMO, which is the small crude oil product. A lot of news surrounding crude. I mean, that market fell from $75 a barrel down to $60 a barrel and now is back in the middle. And that's an ode to statistics like this and range boundedness that wraps probabilities around markets like crude. And yeah, they get a lot of large moves, but if you can monetize how large those moves can actually get, you can monetize in your account, making money off of those moves. So here we've got the 1 standard deviation, 2 standard deviation, and 3 for crude oil as it currently resides. And those of you who've been monitoring the market know more than anyone that in the last couple of weeks, we've seen plenty of $2.50, $3, $4 moves in crude oil, which relates to, moves that occur 5%, 3%, 1% of the time. This is another one that can quickly get us to probabilities greater than even 80% in that passive investment in the stock market, which is to say that when we saw crude oil a couple of times in the last week or so down $3, down $3.50, that's when you look to maybe get on the other side of that historically abnormal move, a move that has a likelihood of 90 to 99% of coming back. You could look at getting on the other side of it and buying that market using these standard deviations. Same thing with some of the rallies we've been seeing now. It hasn't coughed it up quite yet, but crude oil in the last couple of days, seeing some of these multi-standard deviation moves to the upside, potentially a selling opportunity. And what's really nice about that with these small markets is these are moves of a couple $100. Traditional crude oil futures, thousands of dollars of movement per day in there. And what's really nice is that this market only costs about $1,000 to trade. So you can get in there with a small account and trade crude oil for $1,000, and it only moves about $100, $200, $300 on a daily basis. And like I said in the last slide, if you've got a return that's 0.1% or 0.2% on a daily basis, that sort of return annualizes to beat that stock market. And so it's a matter of getting yourself $10 on that $1,000 margin in SMO. If you get to $20, $30, or $40, what we've really done is create the ability to sustainably beat the passive investment in the stock market with small products that in the past, myself included, experienced traders would have kind of scoffed at. Like, you want me to scalp this market intraday, use standard deviations and all these professional advanced metrics to make $20, to make $30? Given how small these markets are and how small the margins are, you can beat that stock market by making $20, $30, $40 on a daily basis. And we've got a ton of markets that offer the same opportunities in stocks, in technology stocks, crude oil there, and precious metals as well. And what's really nice, I love the standard deviation. I love to teach it to people because the standard deviation and the idea behind it doesn't change. The numbers, of course, change, and everybody knows that. We go through markets where VIX volatility is at 10% or even down into single digits, and we go through periods where it's consistently above 20 and 30%. Cyclicality is apparent in all markets, stocks and otherwise, but the standard deviation is always going to show you, okay, if it gets to that first level, now we're dealing with about 68% worth of edge in our favor. If it gets to that second level, 95, third level, true outlier, 99%. And we actually did see that 99% in stocks last week. And that's when, and I joke about this sometimes on our YouTube channel and some of our other segments, these numbers are what makes up ideas like buying the dip, investing when the market is crashing, is because those smart people know, those hedge fund traders, professionals, and everything know that when the market's down 3 standard deviations, it is extremely likely that it's going to bounce back. And so you can look at what we have in front of you, all of those bell curves on the left, and keep in mind that first level is 68, next level is 95, the next level is 99. And just maybe write down some of those numbers to know that, okay, the first level in SM75 is about $1, the second level is 2, and the third is 3, different than technology stocks, which just aren't moving as much. But that first level, same 68%, is 50 cents. Second level is $1, and then the third is about $1.50. And so once again, really love this metric for creating that short-term higher probability that creates greater growth for your small accounts out there, just in a different way. That long-term strategy says, okay, I can get a better return on my investment and thus get to a greater growth potential than larger accounts. This is a little bit of a different take, where it's like we're looking for small returns of 0.1, 0.2, 0.3%, but we're doing it on a shorter term basis with larger likelihoods via this standard deviation. Also attributable to US dollar products, yields in the 2-year, 10-year, and 30-year. We've got these numbers every week for our community members. Another plug, community.thesmallexchange.com. These are just a couple of pieces of those exclusive content and advanced stats that go out to our community members, along with the 50% reduction in fees and exclusive merch that we send out to our community members. This is what they're getting every week, and it does change from week to week, but these numbers should be good for the next couple of weeks. They don't see too many drastic changes from week to week, just small adjustments. And so you can see here in the US dollar and interest rates, smaller levels. These are traditionally less volatile markets, but same opportunities. And we saw this, actually. If you were watching the US dollar, I believe it was the end of last week, start of this week, that US dollar saw a 2 standard deviation rally, and it came back pretty big yesterday, and now it's bouncing back. And so you see these opportunities across all the different asset classes. And this is why I say, you've got $5,000. You want to get a greater return. You want to get more bang for your buck in your stock investment. Very simple. Okay, you can go to that small stocks. You can get right now $7,700 for $700. You could, if you really wanted to, get almost $15,000 worth of stock investment for a little over $1,000 in that $5,000 account. But what I like even better is to get that stock going at a better return with the futures, and then leaving 70, 80% to some of these other strategies in other markets. Also, get your option strategies going as well, as long as you abide by that formula that we looked at. And here, I'll pull it up one more time. As long as you're getting a greater probability of success than that stock market, or you're getting a greater average return, your growth in your small account is going to beat that large account. You're going to get closer to the place that you want to be years down the line in a faster fashion than passively adding a couple $100 with those passive stock investments. So that's what I have for you here today in terms of growth in a small account. I know we didn't cover too many specific strategies. I wanted to lay out the idea of growing that small account, give you that essential formula there of how you beat passive investment, how you beat that large account by either upping your probability of success or upping your average return numbers there, and lay out just 2 strategies, one long-term, one short-term, attributable to so many different markets and so many things on your watch list. If you want some other strategies for creating edge in the way of spread trading, which is another one that I love, in the way of price extremes, which is another one that I love, surf our YouTube channel. We've got so many other pieces of content on strategies that get those numbers to where they need to be to create greater growth potential for that small account. The smalls make futures trading more accessible to more people. We do that with our equity asset class, metals asset class, foreign exchange, technology stocks, interest rates, we're going to be adding a ton of more innovative asset classes as soon as the plans are in the next month or so here. So look for that. Hopefully you find something that piques your interest in these different products. And also, if your interest has been piqued, once again, community.thesmallexchange.com. Get in on the ground floor. We're still taking members into the bandwagon here, but with the way that this exchange has been growing, we've been seeing such great numbers, such great engagement with our community. That bandwagon is going to leave the station at some point. So get in today, community.thesmallexchange.com. A lifetime of reduced fees, exclusive content, limited edition merch, like the hat that's going out to anybody who joins today, as long as you just get our attention, say, hey, Frank, I joined today, or hey, at the Small Exchange on Twitter, I joined today. We will personally get our intern Glenn on sending you that hat right away. That's growing a small account here from the Small Exchange. All the data and statistics I have for you today. Hopefully you enjoyed it. Hopefully you learned something.